Hello everyone! For many long-term investors, there is always this question of should you overweight your allocation to dividend growth-focused ETFs. This debate has passionate supporters on both sides, and each camp has compelling arguments. For today, we'll take a look at two heavyweights in this field: SCHD, the ETF that's all about dividend growth, and SCHG, the ETF that's all about growth. We will compare those two ETFs' construction as well as performance, so stay with us because we've got a lot of ground to cover. Before we jump into the details, do us a favor and give that like button a friendly tap. And if you're hungry for more content like this, make sure to hit that subscribe button as well. Let's start with the dividend growth darling, SCHD. It's a fan favorite among dividend investors, and for good reasons. From SCHD's fund page, it says, the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. This ETF aims to track the Dow Jones US Dividend 100 Index, investing in US companies with a strong history of paying dividends. This means it focuses on investing in companies known for their consistent dividend payments and solid financials. Its objective is to provide investors with a combination of dividends and potential capital appreciation. It's all about cash flow, quality, and sustainability. Based on financial ratios, the fund will invest at least 90% of its net assets into stocks. The SCHD inception date was in October 2011 and has since increased its assets under management to a whopping $49 billion. This ETF has a super low expense ratio, sitting at just 0.06%, which makes it a really cost-efficient choice. Now, let's talk about SCHD performance. Since around 2011, this ETF is up by 183.24%, excluding dividends received. If you count the dividends in, SCHD has a total return of 257% in this period. This shows that SCHD has consistently delivered impressive results, and its track record speaks volumes about its steady performance. We have talked about SCHD in many previous videos, so we will keep it relatively short here and move on to the powerhouse growth ETF, SCHG. This one's been setting the market on fire. This ETF is also from Charles Schwab, but the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. SCHG aims to closely mirror the performance of the Dow Jones US Large Cap Growth Total Stock Market Index. It targets US companies with high growth potential. The main objective here is capital growth, with less emphasis on providing income through dividends. Since fund inception in 2009, it has attracted more and more investors. Today, the ETF has about $19.6 billion assets under management. If you think SCHD's fee is low enough, wait to hear this. SCHG has an expense ratio of only 0.04%. This is probably the lowest expense ratio you'll find among any ETFs in the market. It is good for investors because if you hold SCHG for a long time, you get to keep most of the money earned into the ETF for future growth. Now, let's take a closer look at the Schwab US Large Cap Growth ETF's performance over the long term. This is precisely why many investors are absolutely enamored with this ETF. It has surged by almost 500% since inception. If you reinvest the dividend back to SCHG, the total return is well above 550% for the period. To put SCHG's performance in perspective, let's compare how it stands against its sibling, SCHD. Since SCHD's inception in 2011, this dividend growth ETF delivered 309% total return in 12 years. That's an annualized return of 12.6% per year. While SCHD's return is quite impressive, it still falls short of SCHG's annual return of 15.75% for the same period. Because both SCHD and SCHG are passive ETFs, their return difference is mainly attributed to each ETF's holdings. To provide a cleaner comparison, let's stack SCHD and SCHG side by side. SCHD has a precise method for selecting the stocks it holds. Currently, its holdings are divided across various sectors. Health technology make up 15.7%, finance at 15.2%, consumer non-durables at 12.5%, electronics at 11.23%, technology and energy at around 9%, retail trade at 5.2%, and producer, communications, transportation at just under 5%. Meanwhile, SCHG's portfolio has a strong emphasis on the technology sector. It allocated 34% of the assets in technology services, 23.5% to electronic, and 8.9% to health technology. So the top three sections account for more than 60% of the fund's total assets. This gives a higher risk factor compared to other ETFs, but it also allows the fund to ride the tech rally when the stock market gets bullish. SCHD typically holds a basket of approximately 100 different stocks, and these stocks are subject to regular changes, usually once a year. This strategy not only offers stability, but also brings potential tax benefits to the table, thanks to its diversified mix of sectors and around 100 stocks in its portfolio. SCHD's top holdings include established companies like Cisco, Broadcom, Amgen, The Home Depot, AbbVie, Chevron, Merck & Co., Coca-Cola, Texas, and Verizon. Meanwhile, SCHG has 241 different investments in its basket, and it's able to maintain a higher level of diversification to reduce idiosyncratic risk from each company. The top 10 holdings in SCHG feature tech giants like Apple, Microsoft, Amazon, Nvidia, Alphabet, Tesla, Meta, United Health Group, and Eli Lilly. Let's be real though, when your top 10 holdings include heavyweight giants like these, diversification may not be the primary focus. When the market shifts into a bullish phase, companies of this magnitude tend to take center stage and deliver exceptional performance. Next, we'll look at the dividends these ETFs are paying. And this is the area where SCHD comes way ahead of SCHG. SCHD's current 12-month dividend yield stands at 3.53%. While that is a respectful yield, SCHD has enjoyed annual dividend growth north of 10% consistently for over a decade. Many investors on board with SCHD are not just banking on long-term price growth, they are also betting on future dividend growth rate that will increase the dividend payout even further. People like to have certainties, especially when it comes to cash flow generated for retirement purposes. Compared to SCHD, SCHG's dividend is really small, at just 0.44%. On top of that, its trailing 12-month growth rate has even dropped, and the 10-year growth rate is a mere 2.6%, which falls way below the expectations of most dividend growth enthusiasts. Nevertheless, investors still flock to this ETF as it outperforms the market year after year. They want to see their portfolios grow rapidly in a short amount of time, and for the most part, except for a few hiccups during significant economic events in history, that's exactly what this ETF has delivered. Let's dive closely at the total return, which includes price appreciation and dividends, and determine which ETF would have been the better choice over different time frames. Let's start with the year-to-date performance, and the contrast is stark. SCHD is down by 0.48%, even after factoring in dividends. Meanwhile, SCHG has surged ahead with an impressive 39.80% gain. Over the past year, SCHD has remained relatively flat at 2.54%, while SCHG is up by 19.01%. But here's where it gets interesting. Over the last 3 years, investors would have been better off with SCHD, which delivered a solid 45.41% return, compared to SCHG's 39.21%. In my opinion, both of these returns are still quite respectable. Now, let's zoom out and take a 5-year perspective. Over a whopping 1,826 days, SCHD has posted an impressive 64.26% return, which is nothing short of impressive. However, SCHG takes a spotlight here with an incredible 95.93% return. So, what's the verdict on the debate of growth investing versus dividend growth investing? Both SCHD and SCHG are rock-hard ETFs that can deliver outstanding performance over time. If you prioritize predictable cash flow, then dividend-focused SCHD could be your go-to. On the other hand, if you favor price appreciation of strong companies, the growth ETF might be your pick. You could also blend the two ETFs to build a portfolio that is tailored exactly to your needs. So, which ETF aligns with your investment strategy? Let us know in the comments below. And if you found this breakdown insightful, remember to hit that like button and stay tuned for more informative content. Thanks for joining us again today, and happy investing!